Alrighty, guys, it is the first of the first of the first here. I am kicking off another one of these great events. Lots of great speakers on deck, but this is squarely in my wheelhouse. So, plan the trade, trade the plan is the slogan around here. It was the logo on the coffee mug for the first 10 years of our before we even had a business, and developing a trading plan is really the only thing that is going to get you successful in this business. It gives you something objective to measure your progress with. It gives you something objective to measure, whether or not what you're doing is actually worth doing. And, in the end, I think that if you take the time to sit down and carefully put together a plan each and every day, like I have for the last 30 years, then what you're going to see is, trading can be a lot less mystifying and it can feel a lot less like luck and a lot more like a business. So, for those of you who are brand new to me, and usually the folks who come to see me at these things are people who have seen us a few times, but let me just say that Julie and I have been trading pretty much full time since 1997, and we're trading before that while we were graduate students out at the Claremont Graduate University. We started this business in the early to mid 90s. I mean, before there was charting software readily available. We were using something back then called Windows on Wall Street, and I think that later became TradeStation. So if that doesn't date us, I don't know what will. But we were part of this revolution. We were part of this, SOS bandits and all this great stuff that happened in the 90s as people got access to the markets via what was to become direct access trading software. Commissions were sky high. Everything was a lot more difficult than it is today. And we had the great opportunity to go do a bunch of stuff, gather a bunch of data from the New York Stock Exchange, actually from every exchange in the world. But the real benefit to us, I think the real aha moment was getting down on the floor of the exchange, $2 brokers, runners, specialists in the booths, getting to know these guys and getting to know their personalities and seeing how it was that markets were actually made really opened our eyes to exactly how it is that you can go and plan for and profit from the markets. When we got going with this stuff, the key to trading for a lot of people was let's hop on the momentum. And that was back then. You saw these pictures of these guys who were effectively, they were kids. They were learning how to trade, and the way that they were learning it was a level 2 screen. Looked a lot like a video game. They knew how to play video games. If I can play a video game, I can monitor what's happening on a level 2 on a market maker screen, maybe on a 5-minute chart, a 3-minute chart, a 1-minute chart. And then when I see momentum, I can go and attack it. I can go and hop on, and more times than not, I'll get on the train before it leaves the station. I get on with plenty of time for the momentum to carry me, and I'm going to make some money. And that was great when we had those go-go days in the markets, when the markets were just, every day you got up, you bought something. If you sat on it for 5 minutes, you made $3,000, $4,000. You couldn't believe what was happening. Problem with things that are that unbelievable is they don't stay that unbelievable for long. SOS, the small order execution system, that was a major vehicle for success back then for everybody. You were buying ahead of market makers, getting the price to raise up based on your order, and then going and selling back into those market makers when their price was elevated, and you could just scalp this money off all day long. Well, you can imagine big institutions, they might seem dumb for a little while, they might be wrong for a little while, but they sure as heck don't stay wrong. And what happened was that vehicle, let's say, that vanished. So that went away, and then you saw a lot of trading accounts just, gone. And people who came into it for the lure of easy money, once the easy money, once that appeal was gone anyways, they backed out of it again and they moved on to something else. Well, what we learned from, dealing with these folks on the exchanges and sort of seeing how things operate, seeing how things are really done, was the guy in the booth, he's got a plan. So there's a trading plan that's put together. And what he's really doing is he's bracketing up. He's saying, I'm a buyer here, I'm a seller here, I'm a buyer here, I'm a seller here. And all day long, what he's waiting for is if it hits his sell threshold, he's going to push it back down again. If it hits his buy threshold, he's going to buy. If it dips below his buy threshold, he's going to buy lower, right? Or he's going to sell into it. But he's got a reason for all of this. He knows where support and resistance is. He's looking at the order flow, and he's just saying, this is where this auction market is likely going over the course of the session. And when it does go there, when it goes to these various price levels and levels of opportunity, what I'm going to do is I'm going to go and capitalize on that, and I'm going to make a market right there. And this is what we learned. So this is where we learned. This is how we learned. We were looking at all the data from the New York Stock Exchange. It was a magnificent opportunity back then. Lots of people weren't interested in that kind of data. We were. Behavioral finance was our wheelhouse. And when we moved through our education and we were getting our degrees, Peter Drucker, who most of you guys, if you're probably a lot younger than we are at this point, you don't know who he was, but he was a worldwide business consultant, probably one of the most famous guys in management consulting ever. And he was just kind enough to say, look, you guys have developed something that's unique. You've developed effectively a business that can self-perpetuate going forward. I know that what you want to do is go work for McKinsey and Company, go work as a consultant, and then come back 10 or 15 years from now and teach. Trust me, if you can master this, you do this for the next 5 or 10 years, and you can develop a teaching credential here that's going to rival anything you would do at a university. If that's your passion, you can still do it, but you've got a business, run with it. So that's what we did. We decided, we're gonna focus on trading as a business, and what we really became very well known for back then was these trading plans that we put together. And this was my dream, was I'm going to put together something that can be automated. I'm going to put together something that I work on it tonight, it'll be ready tomorrow. We can get up as late as we want and let the market take care of earning for us. Wasn't quite that simple, obviously. You still have to be there in the morning. It's still a job, and it can be very difficult. But the trading plan definitely makes a very big difference in how you can go about navigating what goes on in the markets. So we've written lots of things over the years about the plans, the strategies, the tactics, the tools, everything it is that we've done for 30 years now that has led to, well, us still being around. And, I've done stuff in all the major publications where I've talked through what I'm doing. And if you go back and you look through all these articles and you look through the strategies that we developed there, and you look through the psychology that we talk about, and really everything that we've done all these years, what you're going to see is that most of it comes back to these things right here. So these books are the crux of pretty much everything that we do to this day. So Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. It's not in print right now. I know everybody's just on the edge of their seat and wanting to know when they can get a copy of that. It'll be later this year. It'll be back, and it'll have a much larger section on trader psychology than it did in the first iteration. The first, 8 editions of Around the Horn were focused on the patterns, on the opportunities for profit, and kind of worked under the assumption that you can get your psychology wrapped around this because it's the way that the markets work. Markets are cyclical. Markets behave in a certain way, and you're going to have to learn how the markets behave in order to participate in them. And it was originally called a multivariate analysis of covariance in the United States equities markets. So what I was looking for was, when you covary something, what you're looking to do is take out the effect of, multivariates, right? So maybe 4 or 5 things. It could be you're taking out the effects of overnight news, you're taking out the effects of economic news, you're taking out the effects of the consumer price index, you're taking out the effects of whatever. And you're saying, all that stuff aside, if something happens in the markets, what's the likelihood that we've got a profitable setup for the day? So we took a multivariate analysis of covariance, which with a title like that was not going to fly off the shelves, as my publisher George Stillwell famously told me. We took that and we rewrote it around an analogy that represents the patterns in terms of baseball. So I like baseball, and I think that baseball is a statistically driven sport. It's a sport that's very unique in the way that it functions. It's not, it's the only game where the defense has the ball, for example, and it's the only game where your statistical implications of each player's individual performance is going to be as important as what a team can put together. So it does things very much, for me, the way that the markets do things. And we put in here patterns like fastball. I'll show you that one in a second. That's the one that we're going to look at here in the trading plans. It's an expansion of range and volume setup, infield fly. That's an exhaustion reversal setup, double header, or if you read the Beat the Street version, the international version, which is published by Harriman House, it's called a Kings and Queens. That's a big shot in one direction that goes and reverses all that momentum the next day. All those patterns are things we can identify on a daily chart, go back, drill down on, and say, here's what we think based on today's price action. This is what's going to happen tomorrow, most likely, if the market follows through. So if the market follows through on what happened today, here is what this pattern suggests is going to happen tomorrow. And that has been very instrumental, and that has been the cornerstone of our business since we first started doing this. So the patterns in Around the Horn, 28 years later, right? I think I wrote the book a couple of years into this whole thing. 28 years later, that's still exactly the way that we go about doing things. The teaching, right, which we love, which if you guys have seen me before or have been to any of the live events that we speak at, well, I used to speak at 15 to 20 things a year because I just love to teach. The teaching evolved because that's our passion. That's something that we really enjoy. It's great. Trading's great. Sitting around all day just pushing money around really, isn't what it's cracked up to be sometimes, especially when you do it for years on end. It's nice to get out there and meet people. It is nice to provide specialized knowledge, specialized education to people who are smart, people who are driven, people who want to be there. They're not just there taking your class as some kind of an elective. They're there because this is what they want to do. They've seen the results of our trading. They've seen sort of how the dynamics play out. Well, now they decide they want to come and work with us. And that's been great. So we put together all of this education that we provide at traderinsight.com. The cornerstone there is the Income Trading Academy and the Income Trading Bootcamp. So that's one course curriculum, one product really. It is intensive. So it's a year-long program. It's not cheap, right? It's a $15,000 piece of education. It's like going to school. It's like going to graduate school, like going to continuing education. It's about 50 hours of online training that you go through. It's 700 pages of workbook and manual that you go through. And then it's 4 days live in Miami Beach. So we don't do it out here in California because the time zone is really not conducive to teaching a room full of people how to do something complicated. Right? Nobody wants to be at a seminar at 5:30 in the morning and least of all have money on the line at that hour when you're coming in from somewhere else and jet lagged and every other thing. But it's really great when we do it in some of these destinations that we've put it together in over the years, and the flagship destination, the place that we do it every time now, is down in Miami Beach. It's been the Cadillac Hotel and Beach Club for the last 10 years. We do it twice a year. Maximum number of people in that room is 20. And we work with them all year. We work with them afterwards for years and years because they're all members. If you've been in our Zoom room in the mornings to see what we're doing, if you log in there, Those guys, it's an alumni trading room. Those guys have all been around. They've been trading together for years, and they are fantastic. And then there's a bunch of other courses that we do. So we do like an opening gap course. We do a volatility band mastery course. Those are online courses. Those aren't as intense as the Income Trading Academy. They build on it. They teach you sort of a mastery level class of what you've learned through ITA, through the Income Trading Academy, and they build skills in addition to what you've already learned. So we've got a passion for this stuff. These are our everyday motivation to get up, get out of bed, and do something. We like everything that we do. We love everything that we do. We love working in the markets. We love working as analysts. We love coming up with trading ideas, and we love even more to share those ideas with our students and to work with these guys ongoing and to see their success as they move through the markets and develop, in a lot of cases, second and third careers. And it's been great. So we've got another one of those coming up in June 8th, 2025 in Miami Beach. If you're interested, you can send us an email and we can talk about that some more. Also coming in 2025 now online is going to be Trader Nation. So Trader Nation, we had a show that we did for network television, and that local syndication is no longer part of our plan, primarily because we were up in Pacific Palisades. Everybody knows what happened in Pacific Palisades, and the studio is over in Hollywood, so it was a no-brainer for us to go out to the studio from the Palisades at 5 o'clock in the morning or 4:30 in the morning and shoot the show once a week. It's a big problem for us to drive up there. We're now down in Newport Beach while our place up in the Palisades gets rebuilt. That's going to be a few years. What we decided to do was we're going to go and move the show online. And it's a great trader psychology piece of work, right? So this thing goes and says, let's take a look at trading, not from the vantage point of what went up, what went down, where do we think the market's going to go next week. There's some of that in there. The majority of what it is let's take a deep dive into the psychology of traders. Let's look at individual traders. Let's look at people who trade the markets. Let's talk to them about how they put together their trading plans. Let's talk to them about what works, what doesn't work. Let's talk to people who are new to trading. Let's talk to people who have been trading for as many years as we have. Let's talk to people who have been trading for more years than we have. And get their input into what made trading easy, what made trading difficult, what is it that challenges, and what is it that propels success. We took dives into some folks who had a propensity to gamble. They were the gamblers. What are the things that make for an easy transition from somebody who likes to play blackjack or somebody who likes to sort of roll the dice on businesses, and what makes that person go and enter the world of trading, and how are they able then to drop that gambling modus, right? How are they able to take that out of what they're doing? Because if you're going to gamble in the markets, you're going to have a problem. How do they go and transition and see, okay, well, there's still an opportunity here to get the adrenaline of being live somewhere and making decisions on the fly, yet at the same time saying, okay, every day is a challenge, every day is going to be different. Yeah, I'm going to have some tricks up my sleeve, but boy, I need to put this thing together and I need to get in front of the opportunities in some kind of systematic way. And I know I'm bringing a bunch of baggage with me. If you look around these tables here, these guys are folks who have been to that mastermind training that we do, that Income Trading Academy. And, as you go around the table, everybody there has their own psychology. There's a guy in the front corner on this one. He's a rancher in Texas, great guy. There's a fellow across the table, sitting sort of next to me there. He owned a chemical company for years. There's a guy who owns a company up in Canada, does sports memorabilia. There's an attorney. There's a physician. All these guys bring different mentalities to the table. That's what Trader Nation's about. That's what we're about. What we encourage people to do is, if you've got something you want featured on that show, on Trader Nation, send us an email with a video attached. Shoot something on your iPhone and say, hey, here's my question for you. I have a hard time following my trading plan because, when I start seeing gains, I book the gains way too quickly. And when something starts going against me, I widen my stop losses and I wind up losing too much. What am I doing wrong, right? That's the kind of content that we're looking for. And if you send it to us, we'll feature it on the new show. I think it's going to be a YouTube show. We'll see here in a few months. I think it's going to be really enjoyable for people because it is definitely the kind of thing that drives behavior in the markets, right? So it's hard to get around that feeling that you want the rush of gambling. It's hard to get around that feeling of you want to book a profit. It's hard to get around the feelings that that a company, well, I had a successful business, I was an entrepreneur, I was successful. If I go to work, I should be able to make money. If it doesn't make sense to me that I come in here and this is such a struggle. Trading is different, right? It's very different than anything that any of these guys have ever done in their life. And the psychology that gets delivered to us is a lot of times very different than the psychology that is required to make a living trading the markets. So the psychology that comes to the table with these folks, not that good-looking guy in the black shirt there on the left, that's our son Connor. He's been to all these boot camps since he was about 3 years old, 4 years old. So he is a veteran. He ain't trading yet, but I'm sure that he'll be doing this at some point in his life. Even he's seen it. So he used to come in and when these guys would get flustered with the market, and he would say, you'd have this 4-year-old standing there and he'd say, look, that's an uptrend, that's a downtrend, and somebody would say, well, how's your dad know where they're going to go? And he says, well, I don't think he knows where they're going to go, but he'll tell you they go where they go. And you just need to figure out a way to plan for the momentum. You need to figure out a way to plan your trades and sort of structure things so that one way or another, you've got mechanisms in place to either work with the trade and get a profit, or get out, keep your losses small, keep your powder dry, and move on to the next one. So we've got some athletes sitting at that table there. I can tell you the guy at the far end of the table, professional baseball player, so played for lots of teams, for Indians and Cubs and Reds. And what he'll tell you is this is very, very similar to his former life, because you need to step up to the plate fresh every time. You can't put on a trade and think about the last time that you got to the plate you struck out, or the last time you got to the plate you hit a home run. There's no good days, no bad days, just days. You have to be able to go and focus on the business at hand, and the way to focus on the business at hand is whatever happened last doesn't count. You know what you have to do next. We put together our trading plans so that we've got very distinctly structured portions of a trading day. We've got NYSE program trades that we put on right at the opening bell. This is what I'm going to focus on today and show you, here's how you put together a trade for tomorrow based on what happened in the market today. You're going to know exactly what to do, when to do it, how to do it, why to do it, what to do when things go right, what to do when money is moving in your favor. How close are you to the profit target? What do you do with the money with your stops as you're approaching a profit target? What do you do when a position hits your stop loss? What do you do when a position hits your target? All that stuff is thought about ahead of time, and all that stuff is baked into the cake, and you don't have to rethink it on the fly during the session. Those trades are the fruit of that around the horn trading philosophy. We're following the market around the horn. We're following market cycles. We're figuring out what's the likely behavior of market participant A, B, C, D, and all of them going to be tomorrow based on what happened today, based on the price action in the morning. What do we expect the traders are going to do? The NASDAQ program trades, very similar. We go through and we handicap what's going to happen in the markets. We've got this setup called the Fastball XRV. And today we're going to talk about the fastball setup, how that gets found on a chart, how we spot that on a chart, how we plan for the trade. The NASDAQ version of the trade is just a little bit different than the NYSE portion of the version of the trade, because NASDAQ and NYSE are different animals. They behave differently. There's more volatility on the NASDAQ. We do things like use fixed swings and momentum-based targets and stops, whereas on the NYSE, we use the natural stops, natural support and resistance, natural targets. Everything's based on, there's one human being on the other side of an NYSE trade who's setting up the parameters, and that's still to this day very much the specialist, or one firm that's making these decisions about where they're going to make markets on the NASDAQ. There's a lot of actors. There's a lot of people who are out there participating, pushing price around. That's going to be a different kind of a trade. The opening gap reversion trades, those are planned. So, we get a list of opening gaps in the morning, and you've only got a few minutes to make a decision about what to do, but the decision is effectively made for you because we're looking at this and we're saying, if the market opens 2 standard deviations out in terms of volatility, if we get a gap that represents a 2 standard deviation move in terms of the volatility that we can expect from a stock, then we've got our price behaving in the 95% confidence interval of the mean. We've got a 95% probability price is going to move back toward the average volatility, and we know that that's where we've got an opportunity for profit. That plan sort of cooks itself up as the market opens. We've got a scanner and a spreadsheet that just populate with, here are the ones that are qualified. Here's the reason that they gapped. We know exactly if it's an earnings gap, what we're going to do. If it's a news gap, we know what we're going to do. We've got the thing down to the point that in the room, in the mornings, if there are 10 gaps, if there are 15 gaps, or if there are 3 gaps, we know how to pick the ones that have the most probability of following through in our favor. And then we've also got these order flow trades. And order flow trading is something that is a little bit more challenging, but it goes back to the guys on the floor of the exchange and seeing where the value line is, seeing where's the volume weighted average price over the course of the session, where is the anchored volume weighted average price of the most recent trend, where are the pockets of liquidity, where do we think price is going based on where price has been, and what do we think is going to happen when price gets to these very, very structured pockets of order flow of volume by price. We go through and do a hierarchical cluster analysis of what's going on with price, and that stuff just pops up on the chart. It shows you visually where the levels are, where the thresholds are going to be, and it tells us what to do. We don't guess. We don't go and say, something's taken off, I'm going to hop on this train as it's leaving the station, and hope that I don't get run over. No, this is about getting on the train before it's leaving the station, right? As it pulls into the station, you're getting on for the next leg of the journey, and you know exactly what you're going to do before you're going to do it. For us, one of the most important things on any given trading day is that we understand what the workflow is going to be for the session. We set this up like a business because it is a business. We set up our pre-market. We look at Apple. We look at some of the super cap stocks, Apple in particular. We've got a market maker arbitrage, kind of a trade that we put on right around the open. It's based on what's going on in options in Apple, and we go and trade the stock right on the opening bell when the market makers are going to go and hedge their bets because they're going to hedge against positions that they're putting on before the open. We've got a strategy that's all set up for that. We've got the around the horn NYSE trades. That's that trading plan that I'm going to show you how to put together here, or what it is that I do to put it together. That gets loaded up. As long as the market's going to open somewhere in line, we're not going to get some big blowout gap open, 1,000-point open or something. We're going to have those trades loaded up. They are conditional orders. Right? If we have an entry price on a long of $50, then we say if last price is less than $50, buy, stop, limit, $50 stop, $50, 10 cents limit, whatever the worst price is we're willing to accept. We load those up because we can. We put them out there with their stop losses, with their targets, and we let them take care of themselves. At the opening bell, we're going through, we're executing that Apple trade, we're executing any kind of NASDAQ trades that we have that are into the volatility band trading plan that we established the night before. That's a whole other seminar, that's a whole other lecture. How do we put together the volatility band trading plan? And then at the 5-minute mark, we start trading the Baltimore Chop 2ST opening gap trades. That's a very full morning right there. But you can see that with all that stuff that's going on, the beauty of having these trading plans in place is you know what you're supposed to do when you're supposed to do it. You're not guessing. You're not hoping that something falls in your lap, that a good opportunity comes to you. You know that you've got opportunities that are set up, and if they play out the way that you anticipated them playing out, you've got a game plan to get into the trades. And if they don't trigger, you don't care. If they trigger and hit a stop, You don't judge yourself. You don't come down on yourself and say, "Boy, I screwed that up," or what's wrong with me? Why can't I do this? Everybody else can do this. Why can't I do this? Because you planned the trade, you traded the plan. Your outcome measure is, did I do what I said I was going to do? That's the thing that's important. If you have a trading plan that you can show makes money over time based on the logic, then you're 3/4 of the way there. Now all you need to do is get the discipline that goes along with your logic and then have the courage of your convictions to follow that discipline. After the first hour, what we do is focus on our volatility band trades. We monitor those automated NYSE trades. We make sure everything closes out before the end of the session. We monitor the NASDAQ trades, and we focus on the volatility band order flow trades. And that happens from about 11:30 Eastern time right into the last hour of the trading day. So that's how the day is divided up. We take a break right after the first 45 minutes to an hour. We're gone for about an hour and 15 minutes. We come back, took a walk, went to the beach, right? Walked on the beach, used to hike up in the mountains and the Palisades. Do something to clear your head a little bit, come back, and get ready to trade the rest of the day. That's our day. So that's our plan from the vantage point of, here is what we're going to do. I think that, the beauty of doing things this way is, and we haven't even got into structuring the trading plan yet, right? What we've talked about so far is this is how you structure your day. That's part of your plan. Don't get me wrong. It's not just about where do I get in, where do I get out. It's about what am I going to do? When am I going to do it? Why am I going to do it? Do I know the rationale for not just the metrics of the particular trade that I was going to get into? Do I know exactly why I'm doing things based on my workflow? So workflow is a very important thing for traders. The traders who I've seen over the last 30 years who have the hardest time doing this are shooting from the hip. They've got some piece of software sitting there, and that thing is just spewing out, here's the big gainers, here's the big losers. Usually the big gainers are going to be cheap stocks, they're going to be penny stocks, and that stuff is very reliant on being driven by chat rooms, being driven by, it's a game of musical chairs, and you don't want to be the last one standing when the music stops. That's the moral of that story. Low dollar stocks tend to put in those big moves, and a lot of guys for a while will be able to profit from the momentum. So they've got a scanner. A scanner is, feeding them symbols all day long, and as long as they, keep getting lucky or keep picking the right symbol, they're able to make some money. And then when it goes against them, it goes against them fast, and they can wind up wiping out, 3 weeks worth of gains with one position. That's not where we want to be. And that's certainly not what we teach our guys to do. So everybody who goes to the boot camp, that's almost like a pledge. You're saying, listen, I am not going to trade like that. And what I'm going to do is honor my discipline, and I'm going to see to it that the opportunities that I get in front of are the same kinds of opportunities that I would be looking for if I was working on the floor of the exchange, if I was a professional trader working for a firm and had to explain my actions to somebody at the end of the day. A lot of people have trouble with, the person they're explaining their actions to at the end of the day is a spouse, or is a best friend, or is, somebody else they got into trading with. And rather than explaining it in terms of, the logic and the reason behind what they're doing, they're trying to justify what they did, or they're trying to not be embarrassed by what they did. That's not where you want to be. You want to put together your trades based on something that says, I've got years of data that I've looked at. I've got a lot of valuable insight based on the price action that I've monitored over time. And, I think that I can make a go of this based on my understanding of what's happening in the markets. And then you look at the results, and you look at the results over time, and it's not today. It's not today and tomorrow. It's not this week. It's, maybe not even this month. You look at it over the course of a history, and you'll find out things like, we don't trade on Mondays. So Julie and I don't trade. We don't put together a trading plan on Mondays. We don't put together, any kind of go time for the markets, because we found, after looking at back then probably 10 or 15 years worth of data, Mondays at best are a push. And it's because of news. It's because of what happens over the weekend. It's because the weekend doesn't interact with the market the same way a weekday interacts with the market. There's a lot of things that happen. There's a lot of geopolitical stuff that happens. There's a lot of shock that comes into the markets, and you get a headline-driven market on a Monday far more often than you do on a Tuesday through a Friday. So these are the metrics, right? These are the things that over the course of your career, if this is the career you're choosing, you have to keep your finger on the pulse of. You need to know things like, well, mornings between 8:30 and 9 o'clock Pacific time is when it's best for me to come back and start looking at the markets again, because at 7:30 Pacific, at 10:30 Eastern, till 8:30 Pacific, the market needs to settle in. And once the market settles in, my volatility band plan starts to work perfectly. That's valuable information. That's only going to come to you if you have a very, very structured way of looking at your work and looking at what you do. So let's take a look at putting together a trading plan. I want to talk to you about one of the patterns that made Around the Horn a bestseller, and that pattern was called fastball. Here is the fastball expansion of range and volume. So this has some very, very specific strategy guidelines. And, one of the key components to everything that I do is we're going to keep it simple, but we're going to keep it very specific and very unambiguous. For this particular strategy, we want to see a breakout from a pullback or a consolidation in a trend. We want to see that breakout day be the widest range of the past 2 weeks of trading. So it's going to be the widest range of the past 10 daily bars on your chart. That day has greater than average volume. So that volume doesn't have to jump out at you the way that the range does, but you definitely don't want to see a low volume day with a big wide bar. You want to see volume that's significant. And we're going to enter tomorrow beyond the extreme of today's bar. And all I mean here is if the breakout bar is on the long side of the market, right? If it's a long breakout, if it's the price went up and we've got a giant bar, opened low, closed high, we're going to go long tomorrow after the open on a violation of today's high. Vice versa for a low. So just invert the whole thing for a low. If the market's trending down and then pulls back and we have a big breakout to the downside, we're going to get short 10 cents below the low of the bar that created the breakout. And really, you can put these idealized examples of this together, and get a really good, clear visualization. If these are daily bars, and this is the trend, and then we have this pullback, so now we're pulling back down towards maybe the VWAP or the 50-day or 200-day or whatever it is, whatever metric it is that you're following on a chart. We're pulling back down to somewhere in the range that we just moved up through. And then we have this big wide range bar. It's going to be, widest range of the past 10 sessions, gets us up and out of there. What we're going to look to do is get long 10 cents above the high of that bar in tomorrow's trading. So intraday, I look at these on 5-minute charts. We're going to, knock it down to a 5-minute chart in a bit here to show you how that works. But on a daily chart, we're always going to focus first on where is the breakout, where is it happening from, and that's how we're going to time the entries then on the intraday chart. So here we've got a pullback. We were moving lower, pulled back up into the range. We've got a breakdown, expansion of range, expansion of volume, 10 cents below the low of that bar the next day is where we're going to go short. When we have a consolidation, these can go either way. So we don't know if that consolidation range is an accumulation range or a distribution range. You don't know it until the breakout happens. But you've got a trend that was markup. You've got a range. We don't know what that is yet. When it breaks out, we say, oh, we think that range is accumulation, and now it's breaking through the overhead supply. We're getting up and out of there. We're going to go long 10 cents above the high of that bar in the next day's trading. If we trend up and we consolidate and it turns out we're in a distribution range, we'll know it because we've got a breakdown that next day. And when that breakdown happens, now it got through the support, it got through what was propping it up, and 10 cents below that low, we're going to look to go short. If we trend down into a consolidation, same principle. If we've got an expansion of range, expansion of volume that breaks us down below the consolidation, we're going to go short 10 cents below that low tomorrow. And if we've got a consolidation that comes down from above and then it tracks sideways and breaks out, goes back up into the range. Then what we're going to do here is long 10 cents above that high. So you can see there's a very, very just disciplined approach to identifying the opportunity. We've seen it. We know what it looks like. We know what the pattern looks like. We see the wide range bar. We are going to wait for confirmation the next day in terms of it's got to get 10 cents above that. 10 cents comes from the days we were trading at eighths of a point, right? So it was 12 and a half cents really is an eighth of a point. We were trading in eighths and quarters when we started. I wish we still were. That was some real opportunity for profit. Decimalization, I think, was a bad thing for traders, bad thing for this industry. It made spreads too tight, made it harder to profit. But you deal with the world the way that it is. It's not about what you want to have happen. It's about what is happening, and that's what is happening. We wait for a 10-cent move. That's the confirmation. We've got conditional orders that we set up. So we say the conditional order is it has to be, if it's a long, it has to be below that entry line. When it gets to that entry line, we want it to go and put us into the position on the long side of the market. We've got a bracketed order. The bracketed order says if we get to our target, we're going to exit the trade. If it gets to the stop, we're going to exit the trade. If we get 50% of the distance to the target, we're going to move our stop to break even. If it gets 10 cents to the target, we're going to move our stop to break even. That's it. That's all the rules that you need to know to trade effectively using what I've done. There's other things, you might have a totally different system. You might be trading options, futures. We trade futures too. That's a different Megillah, right? That's a whole different way of looking at the world. But when you're doing this, right, if you're doing this the way that we do it, the way that our guys do it, you're following that discipline. And what you're going to do is you're going to make sure that your conditional order is set up with a stop limit so that you have slippage accounted for. You're not going to get some wild slip. If you do market orders, you might wind up getting in when your order's at the profit target, okay? Because they consider 1, 2, 3, 4, 5 before you have to get filled. And in that 5 seconds, what happens if the stock already moved the dollar? Now you're going to get filled at the target. So build the slippage into the trade. Stop limit orders. If you miss it, you miss it. There's no cost to missing a trade. Opportunity cost is not going to knock you out of this business. What is mistakes that are due to having a slip that's just set up way too wide. And as long as things are set up just like this, the trade's moving in the direction you want it to go, it hits your trigger price, it's got a bracketed order that's out there ahead of time, you know why you were getting in, you know why you were going to do everything that you were going to do. You don't have to be there. The only thing you being involved in the trade can really do is mess that trade up, because the discipline is built into this model that you put together. It's built into your plan. So let's take a look at setting one up. So I'm going to tell you the fastball setup, as I'm going to show you in a few minutes here, is a lion's share of profitability when it comes to these trading plans over the years. I'll show you a few years of it, and then you can go look at them yourself and go all the way back. We've got trading plan results, the blotters, the actual plans, all the way back to 2006 available on the site. You can go take a look at them. But, they've been very much a part of every single trading day for a long time. Now, what happened in the past, so we are, as of this recording, we're in May of 2025. And you know that in January through late April, we had a lot of geopolitical news, and that geopolitical news was creating a lot of wide ranges. So it was very hard to have a day that actually qualified as a fastball setup, because there were so many wide range days, because you had tariff news, and you had news about oil and gas, and you had news about inflation. You had all this the landslide of stuff coming at you every day. So this wasn't as prevalent over the last couple months as it is in general, but it was still prevalent enough to book some very impressive results. So let's look at Procore Technologies Incorporated. Here you see a chart of what was going on with this stock, and this was this was in March. So this was before the tariff news really hit. This was what I would call normal trading, inline trading. And you can see we had a big downtrending market, and then we had a pullback up into that trend, got us back up into some overhead support and resistance. And when we got there, sellers hit the market right where they hit the market before. So where the market had collapsed in the past, it had come down in early March. It came down from this threshold level that we're at right now, and it moved lower. This is a daily chart again, and you can see that the last bar on the chart is moving lower right about where the market moved lower from before. And what we're banking on is that as institutions are selling into the market there, that what we're seeing is order flow that's probably not satisfied by the end of the session. So when we see the market close out at the extreme, it opened high, it closed low, and as the market was closing out, we're getting a lot of order flow that's hitting the tape, and that says to us, institution didn't get done what they wanted to get done. And institutions are very much focused on the VWAP. They're focused on what's going on with the volume weighted average price over the course of the session. That's how they're compensated for the trades that they're making for their clients. And when it goes out heavy like this into the end of the trading session, what we're banking on is that tomorrow, if this baby starts ticking lower, if PCOR opens up and it didn't gap higher, it started trading right down there and it starts trading lower, they're going to go and push the market. They're going to go pile into this trade pretty quick to get that trade closed out, to get that trade done as close to that closing level as they possibly can. And we're going to say that if they are done and price starts moving back in the other direction, if it gets above, you can see that $70.41 level that I have labeled there on the chart, that blue line, that's going to be my stop. Because if it gets above there, then I think it's probably headed back up into 71.22, might even be headed all the way back up to retest that overhead support and resistance. And, while you can say, well, you could let this swing for a few days, a few days, you don't have 4-to-1 leverage. So at the end of the trading day, your leverage is going to go from 4-to-1 for an intraday trading account to 2-to-1 for an overnight account. So that's one of the reasons that we close everything at the end of the session. And for another, we just don't like the overnight risk. We don't like to hold it overnight. I don't like to wait and see what's going to happen. I say if it gets above $70.41, then this thing is not for me anymore. I don't want to participate in what it does next. We've got that very big volume by price bar out on the right side of the chart, that green bar there, that says, hey, wait a minute, this is where there was a significant cluster of volume. And if that cluster goes away and price moves up through it, you don't want to be part of what's happening next. Then we go back out to our daily chart and we say, where is the demand? Where do we think that if this overhead supply starts selling again, if whoever it is pushing that stock lower starts hitting this thing and they just start pumping down into that range, where do we think that there's going to be demand for the stock? Because that demand to me says I'm at my profit target. So if I get down and I'm below the next level on this chart here, I'm going to get out of that position for sure. And I'm going to tell my guys, the reason you want to do this is it could be the case that it's going to extend, that it's going to wind up the day way lower than our profit objective. But there's a couple things at play here. First off, on a typical day, what's the range of the stock? As you're looking at that range, you say, if I get from my entry and I get down to that target, I've probably eaten up 80 to 90% of this stock's typical range. How many times can I expect the stock to really go and do a very big range, given what it's done on any given day? Probably not that often. And what do I think is going to happen if it gets down to where, 1, 2, 3, 4, 5, 6 bars had really strong support and then the thing actually popped higher previously? I think that that's an institution sitting there saying, this is our buy line. This is where we're willing to pay for the stock. We're not going to pay for it any higher, but we're willing to buy it down here. So while the guy up above is pushing it down, the guy down below is saying, okay, bring it down here to me, and I'm going to pick it up. So we've got a trading plan put together. We've got an entry, we've got a stop, and we've got a target. So I'm very, very specific. This is what my plan looks like on any given day. So every day for the last, since 1997, this plan has been out there. And, originally it wasn't put together for retail traders. This was something that was put together for a market making firm and for us. And, back then, it was this simple. This is your gouge sheet. This is where you're looking, all right, what am I going to do with PCOR? It's a fastball, so I know it's an expansion of range and volume. It's a short, so I know I'm going short 10 cents below yesterday's lowest price. My entry in this point, $69.78. So I'm going to set up a stop limit order, sell short PCOR, 69.78 stop, 69.68 limit. Right? I might give it maybe 10 cents worth of slippage just based on how the stock trades. If it reverses after I get in and hits $70.41, I'm out. That's my exit. This is the point at which I don't think my trade is still valid. My plan says there's a reason that this stuff is happening. If I get to $70.41, I think that this stuff is no longer happening. The focus of my trading plan has changed. What's going on behind the curtain is no longer what I thought it was. 70.41, out. I'll take two entries, right? If it comes back down to the entry price again, I'll take another entry on the trade. Fool me once, well, okay. Fool me twice, I'll get out a second time, but I ain't getting in a third time. So twice on every one of these trades. My initial target is $68.95. So if I get to $68.95, I'm not gonna coulda, woulda, shoulda this thing. I'm getting out. The only time that there are raised eyebrows in this house or questions about how somebody handled the trade is, why didn't you get out at the target? Well, I thought it might go further. No, this is not about thinking where it's going. This is not coulda, woulda, shoulda. This is, I've got a plan. I'm going to execute that plan like a machine. And the thing that I'm going to hold myself accountable for is, did I do what I was supposed to do? If it gets to $68.95 and it keeps going and it winds up at $52 or at zero, and you manage to be part of that, and you got yourself a $15 or a $20 or a $70 profit on the trade, then what you need to do is look in the mirror and say, that trade was a failure because I didn't do what I was supposed to do. I violated my trading plan, and now what I can't do is trust myself to follow through on the next trade that comes my way. So once you've done it, one of the worst things that can happen to you is violate the rules and it goes in your favor. I cannot tell you the number of people who will go and say, yeah, you know what, but last week, I got out at the target on one, it went another 80 cents, it went another 90 cents. And I say, go back and look at the trading plans, look at the gouge sheets, look at the blotters, and you tell me how many times something hit the target and the result wasn't you were going to do best if you got out at the target. Almost all the time. If you don't get out at the target, you're going to wind up getting out with less than the target. It's that intermittent reinforcement. It's one of the most powerful principles of psychology. Intermittent reinforcement will have a rat pushing a lever in a box until the rat dies because it thinks that it remembers the time that it got a pellet for pushing the bar. And it'll do the same thing to your trading account. You will avoid taking targets because you remember the 1, 2, 3, 5, 10, whatever times something went and put in an extension. And what you forget about is 90%, 95% of the time, taking the target exactly at the target is the way to lock in the profit and not wind up losing some of what you just worked for. The ratio on this trade, 1.32 to 1. I'm okay with $1.32 earned to $1 lost. I'm okay with 1 to 1, actually, because these trades have a very, very high likelihood of follow through. They have a very high probability of success. When you have a high probability of success, you can take tighter and tighter reward to risk. If you have a low probability of success, then you need your winners to be 3 times, 4 times, 5 times bigger than your losers. It's all about the probability map that goes along with the type of trading that you're doing. It's all about the statistics that drive the numbers that you're putting up. This number down here, 50% to target, is here for a reason. So this is on the gouge sheets because what this tells us is if I get in at $69.78 and I start moving in the direction I want the trade to go, trade starts moving lower, starts moving down towards my short sale profit objective. If it gets to $69.37, I'm going to move my stop from $70.41 to $69.78. The stop is now break even. The trade is risk-free. If I get 10 cents to the target, if I get to $69.05, then I'm going to move my stop to $69.37. I'll move it down to the 50% to target area. I'm not going to complain if I get taken off at the entry price for break even. I'm not going to complain if I get taken off at 50% to the target. What I am going to complain about is if it gets to 50% to the target and then reverses and I don't get out at the entry price because I think it might be coming back around again, or it gets 10 cents to the target and I don't get out at 50% to the target because then I didn't follow my plan. If I don't follow my plan, I have absolutely zero way of quantifying whether or not I'm thinking correctly about what's going on in these markets. Here is the chart of how this thing played out over the course of the day. So right after the opening bell, it ticks within our bracket. Okay, so it opens a little bit lower. Your bracket order's out there, it's live. It's saying, all right, if it gets above the entry threshold and it trades down through it, right? If I get down through spot 78 there from above, I'm getting short. So it's going to tick you in, and this one goes down and it immediately hits the profit objective. And then it keeps going, right? It goes down a little bit. You know, we get a move down into the next pivot line. You know, you get down to $68.10 or so. That's okay, because we did what we were supposed to do. We've got a quantifiable way of assessing whether or not we're doing things right. And if you're doing this the way I'm showing the guys to do it, you should have a lot of trades that are happening at the same time. You should have a lot of things going on. There's a busy morning here, and you're not supposed to be micromanaging any one of these things. The only thing your fingers in this pie are going to do is mess up the pie. You can see over the course of the session, right? It came back up, it went through our threshold levels, and then it's ticking around inside the range there, and then going to the closing bell, comes down, hits the profit target a second time. Never went up and hit the stop. Keeps moving over the course of the session, and all you care about is, did I follow my rules along the way? If it got to 50% of the distance to the target, I know I'm supposed to take off the trade at break even. And if I did take the trade off at break even, if it would have gone 50% and ticked me out, there's nothing to complain about. You're done. You finished. You did it right. You did what you were supposed to do. You're a success. It has nothing to do with whether or not you booked that second profit. So on a daily chart, you can see here what happened. Oh, look at that. It went right down to that area, right down to that liquidity area that we were talking about where, if it gets down here, this is where the buyers are. And yeah, it ticked a few pennies beyond us. It got down another, to that 68.09 level or moved further than we thought it was going to move initially. But it got right down to those tails, and when it hit those tails, the buyers came back and the buyers stopped the price momentum. This is what we're looking for. This is what we want to see when we go through and assess, are we putting the plan together correctly? And then, if you guys take me up on, we've got a free couple weeks in our war room that you come and join us and see what it is that we're doing. You can go through and look at the analytics behind all the trades that we've done, as I said, back to 2006. So here is, the year by year. So here, this is 2025. You can see, it's flat on top of the equity curve because we haven't gone beyond May yet, but you can see the way the equity curve is moving. And if you look up at the pattern distribution and the triggered pattern distribution, those pie charts up top, what you see is we're not cherry picking patterns because we like them. The patterns that we're seeing happen in the markets, like that blue wedge of the pie, fastball. If you look at the pattern distribution and the triggered patterns, oh, look at that, they're about even, right? The proportion of the pie is correct in terms of how often did we find certain things to how often did they trigger. What you don't want to see happen is a giant wedge of the pie that says fastball on your pattern distribution, and then a triggered pattern distribution where it's just a tiny, tiny amount. That says you're picking the patterns because you like them, but the reality of what's happening out there in the world is different. This keeps you honest. This keeps you in front of, I'm not introducing a selection bias into what I'm doing. Same thing for longs to shorts. This year has been primarily about the short side of the market. You can see the shorts on the pie up there vastly outnumber the longs, and then look down below. oh, the profitability generated in the market, very much coming from the short side of the market, and the representation of the longs is much smaller. So things are lining up, things are making sense. I can see day over day, week over week, month over month, that I'm on the right side of the market. When I look down at the pattern profitability, the bar graph, I see those are representative of what's going on in the pie charts. That fastball pattern is generating a big chunk of profits. The infield fly is second in line, just like it is on the pie chart, right? And you go around the horn there, you go around those patterns, and you'll see this happen day after day, month after month, year after year, right? So here is last year. Look at it again. Same thing. Your metrics are what's telling you what's going on. It's not about dollars in the account. It's not about dollars earned today. You might not have been there today. You want to see what your plan did, even in your absence. You want to see, hey, was I on in terms of picking these things? I've been away for a month. I've been away for 2 months, but I've been setting up my plans, even though I'm, on the moon. I'm on some space shot, and, I'm putting together the trading plan, and I just want to see, am I still putting up numbers that make sense? Now I'm back 3 years. Right, here's 3 years worth of data. So now I'm back into, this is 2023, I think. Here we go, 2022, right? You go back and you just look at these, right? What happens? What happens over time? What happened during COVID? Where were we? What did the trading plan look like? I don't know what other people were doing, but my trading plans were putting up numbers that made sense given what was going on in the world, right? Things were happening the way that we expect them to happen, and that's what I can hang my hat on, right? What I can look at is, what does the plan do in terms of performance? It's not about you. You could be having a bad day. You could have put together the plan and had 2 martinis and went to bed and got up and forgot to enter your trades in the morning. But you can look at this and say, this is what the plan did. This is where the performance is. I know what to expect from what I'm doing, and now what I need to do is go perform. So this is your link, traderinsight.com/trade. If you join us, I think you're going to be impressed. I think you're going to enjoy this. If you're an intraday trader, people come in and, they see what it is that we're doing, then they get in line pretty quick. We've got lots and lots of people who wind up going to the boot camp from this kind of thing. We pick 20 people to work with a year, and it's not very hard because people tend to sort of self-select. They come in. We're a small operation. We are not a big trader education business like some of these things out there that are, trying to push 2,000, 3,000 people through a year. We're just trying to work with a group of people who we can talk to every day, a group of people we can be friends with. We go on ski trips together. We go on scuba trips together. We go on vacations to Europe. We go on vacations to Napa Valley. We go do things throughout the United States. I'm going to see a bunch of people over the next couple of weeks because our trip to Miami Beach, we've decided we're going to decompress after the fires and we're going to take a driving trip. I am going to see our clients. We're going to stop and visit in Arizona. We're going to stop and visit in New Mexico. We're going to stop and visit in Texas. We're going to stop and visit in Louisiana. We're going to stop in Florida. We've got stops all along the way because these are people we've got very, very close to over the years, and it is a common psychology. It is a common dynamic that drives all of us. So if you want to be part of that, come on in, traderinsight.com/trade. I would love to see you there. That's it for me for today. I know I'll be back here soon. David always gives me a call and says he's got something interesting going on, and I like participating in these things. You've got a lot of great speakers coming your way, so enjoy it. And remember the mantra, plan the trade the plan, and by all means, plan for success, plan for happiness, and lots of time with your friends and family. All right, have a great day.